Hey guys, Xander here with a trade idea for you. This is a trade that I have on right now in bonds. And very simply, what it is a long dated, deep in the money call on a bond ETF, TLT in this case. And then you sell weekly calls against that. It's really that simple. It's the same idea as having a covered call strategy where you own 100 shares of the ETF, and every week for every 100 shares you sell one call against it. However, in this case, it really is less capital required to buy that long dated call than 100 shares, much less capital. Why did I choose these specific numbers here? Right here, you can see I have on two January 15th, 2021 calls, average cost of about 1560, a little bit less than that. And the calls I'm considering selling for next week are the 164 and 163.5. Why these numbers? Well, that long dated call, I chose something that would get me over 80 delta. You can see 80 times 2 is 160, right? So it's a little bit more. And I want it to be far enough out in time that I don't have too much data decay to worry about. And of course, I don't want the cost to be prohibitive either. It's a lot cheaper to buy a call less than a year out than a year and a half out. So there are different expirations you can choose, but that's roughly the sweet spot as far as I'm concerned with this trade. These weekly calls I've chosen to allow me to break even at the very worst to the upside. They've averaged somewhere between 30 and 40 delta when I open them. That's just how the math works out. But those are the numbers. And I'll explain in a second, actually, right now, why that is. See, when I opened these calls, the spot price of the underlying was about 164, a little bit higher than the other one. And, well, if you'd sell a 164 call against that, then if you close it out right there, it's fine. The long calls didn't lose anything, and the short calls expire worthless. You can roll the short calls higher if you want, but there's really very little risk to the upside. Now, you might be asking at this point, hey, didn't I see that line go negative? Yeah. Due to the arcane nature of options math, the gamma is theoretically higher if there's a large upward move in the front dated short call. So that is something you'd have to worry about. But you would, in all likelihood, have plenty of time to close that out before that happened. So either by rolling it higher or just by buying it back. So I'm not too worried about that. And the fact that I'm not worried about allows me to sell closer to the money, that 30 to 40 delta range, which really generates some significant premium. Downside risk, well, yeah, obviously that long call is going to lose, but a lot of investors recommend that you have some exposure to bonds anyway. So since that's something I want to keep over the long term, I'm allowing that, and I'm not worried about that downside risk. Okay, how did I do with this strategy? Well, don't be fooled by that higher account balance up there. That's from stuff other than bonds. I've actually lost 125 bucks on this covered call strategy so far in 2 or 3 weeks, but I'm not worried, and here's why. Look, even though the long calls together are down about 250 bucks at market close last Friday, if you follow all of the covered calls I've been selling against it, they add up to about half of that loss already. You can add those up yourself. It's roughly the 110 plus a little more. It's about 125, about half that total loss. And that is even when the daily chart has not looked so pretty. When I opened on the 22nd, it was fine. When I opened the other one on the 28th, it was fine. And then bonds really took a beating here during the week, but it's still more than salvageable. If it just sat there for the rest of the year, I'd be happy. If it kept going down, I could still make money on this covered calls. Obviously, when it goes down, you do have to sell closer to the money to generate significant premium, but um, that's not a problem yet. As you can see, if I sold the 164 call, that's just the spot price where I opened this trade, the first one, I would be fine. Let's go back to the diagram here. You can see that that's trading. It'll probably open about $70 market open, and hey, that's actually a pretty good cost basis already. If you think about the individual, like for every one call, you're down 125 on the long side, but I'm already up, say 60 on the from selling calls, and hey, if you add another 71 to that, you break even in a week. You could go lower than that, 163.5, and do a little better at the end of the week. And as always, there's really not any upside risk as far as this trade is concerned, not in this range at least. So I have no problem selling a 163.5. Maybe I'll sell one of both. We'll see. So there's my trade in a nutshell. There's really no secret. It's pretty simple. But I'll keep you guys updated how this works. It's something I want to continue doing in the long term. And I know bonds are not the most exciting thing, always that old 60-40, right? But hey, this is one way to do it. So hit me up in the Discord. Hop on the Discord channel. It's in the description. If you have any questions, I post my live trades there too, most of the time. And that's about it. So hope you see some green on your screen in the near future, and peace out, guys.